Hello and welcome back to the Note. It's been a fairly ugly day on world stock markets today. Stocks generally down, bond yields sharply down, commodities down. Generally a risk-off day, even though there's no obvious economic news to get people feeling more nervous. Now, I'd like now to concentrate on what's perhaps the central mystery behind a lot of what's been going on so far this year, which is why is the dollar as weak as it is? Now, if we take a look at this chart, you can see this is rebased back to the recent high for the dollar's trade weighted index, which is back at the end of November last year. You can see that the decline is significant, and part of it is fairly straightforward to explain. You can look at it with regards to the Canadian dollar there. The Canadian dollar is very dependent on commodities because that's how the Canadian government, the Canadian economy derives a lot of its income. When commodity prices are going down, then the dollar will tend to be stronger against commodity-linked currencies. The commodity complex started to rebound at the point that stock markets also turned around in February of this year. So it makes complete sense that you would see the dollar weaken very significantly against the Canadian dollar since then. What is harder, however, to explain is what's happened against the yen in blue here. Now, the yen is regarded as a safe haven until February, as people were nervous about a recession in the US, and the idea that there were going to be several rate rises this year was steadily scrapped, making the dollar weaker in the process. It's fairly straightforward why the yen would have performed as well as it did. Why it is still doing as well as it is doing since then is hard to explain. If you look at the Fed funds futures market, you have seen some increase in expectations for rates for the rest of this year. Yes, in Japan itself, the latest announcement from the Bank of Japan does seem to rule out the possibility of further cuts ever further into negative territory, which would strengthen the yen against the dollar. But it's still hard to avoid the conclusion that a lot of bearishness about the US economy and a strong belief that the Fed really isn't going to be raising rates is written into prices. If you believe the Fed funds futures market, people only put a roughly 50-50 shot on there being even one more rate rise this year. That's not what the FOMC members themselves are saying, and it's certainly not what most economists seem to think either. There is an intriguing disjunction going on there, and that is perhaps the leading cause of taking the dollar down. Now, if we take a look at this next chart, this compares the euro exchange rate against the dollar against the gold price. As that red line for gold, you can see, has hit $1,300 per ounce for the first time in a while today. It's been rising very much in unison with the euro's rise against the dollar. Again, this is reasonably straightforward to explain. It does look as though the rise in gold has a lot to do with the weakness in dollar. That makes sense. If your reserve currency weakens, then the appeal of gold is that it holds its value when paper currency loses its value. Therefore, gold would go up. It does look to me as though there is a risk at this point that we are again seeing a scare in which the chances that rates stay lower for longer may be overstated by the market. That would imply that there is a risk both that the dollar is going to rebound upwards before much longer, and therefore also that there could be a risk that gold could decline again.